Hi, good afternoon. I'm Chris Chelius with the Option Ranger Group and Time Leverage Capital. Today is Tuesday, April 8th, 2014, and welcome to the Writing Calls for Premium Income, a flat to down market approach. Now for an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk, tolerance, and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box. We'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. And without further delay, welcome to the Writing Calls for Premium Income, a flat to down market approach. Mr. Mueller?
Thank you, Chris. Today we are going to be having a discussion on how to sell, write, or grant call options. We're going to go through some quick definitions and scenarios for when such a transaction is considered and look at some specifics using the Dow Jones Industrial Average as an example. First of all, as you can see in our market section, we do have all of the particular markets listed, and in this particular case, as you can see, we have the Dow Jones Industrial Average, and as all markets, it is accompanied by a chart on which you can click for further information. You have all the tick size and trading hours, as well as an extensive list of primary and secondary sources to monitor prior to entering into a trade and also while in a particular transaction. As you can see, many of these are linked to a primary location where you can follow the news as they materialize. At this moment, let's go ahead and have a look at the scenario when writing a call is to be considered. We go to our strategy gallery where a speculator, a trader can have a look at their market outlook and examine different strategies that may be suitable for that outlook depending on the individual. Today, as we indicated in our cover, we are looking at a strategy that is directional in nature, that is bearish. So anybody that is bearish would be considering this strategy. However, as you know, there are multiple ways of being bearish. This entire column consists of bearish strategies, all of which can be considered. So we are going to fine-tune this opinion by saying that this is a bearish strategy that anticipates, and this is very important, that is anticipating a diminishing volatility. So a person under this outlook is looking for the market to drop, but equally important, the way to select this strategy over another is by having a falling volatility outlook. The other strategy that is suitable or that can be considered for a falling volatility outlook is a ratio put spread, which we will not be examining today. Both of these strategies, parenthetically, are margin strategies. So once we select the sell a call, which is what we are examining today, as you can see, there's a graphic here to give you a quick reminder, and visually this will work after a little practice, of the scenario under which selling a call would work. When we go to our strategy gallery in particular, now once you click on that, you come to the particulars of this strategy. And here we see selling a call. First and foremost, there's a graphic. There's a description, an at-a-glance description of the features of the trade, followed by more specific trade details, and a demonstration of how to input a selling call strategy into your analysis software or your modeling software. As you can see, selling a call, as we discussed, is when a person believes that the market is not going up or will not reach the strike price anytime during the life of the option. If this is the strike price of the option, as you can see, the strategy collects premium, so this is the premium collected, and the strategy makes money if that premium is kept or most of that premium is kept. Under this scenario, as you can see, the position, once the market rallies, if it goes up, 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 then the position begins to incur losses, whereas on any sort of a drop, the maximum premium is kept, and you see the numbers diminish to the left and increase to the right. Intuitively, this will be much easier to understand when you see it on a spreadsheet, which is both shown in the demo here, and for people who want to have an even more detailed review of selling a call, you can go into our section, which is our reference materials section, and there you're already going to see that we have an archive with an original demo and a couple of other programs specifically reviewing the strategy of selling a call and the risk to reward scenarios based on intrinsic value, as well as based on monitoring premium. In addition to having that resource, you have in our reference material section, you have the option sheets where there's a further discussion of terminology, Greeks, which is the various ways volatility is measured against the underlying contract and against other variables, and additional literature on how to attempt to achieve or understand how an option valuation edge can occur. And finally, let's go ahead and have a look at our strategies. We're going to go to our basic strategy calculator. Let me go ahead and reset this calculator so we can see how it looks from scratch. This is the input screen, and as you know, we have on this side a series of calculations that we are currently monitoring that are saved, and today we have today's session on selling Dow Jones calls separately indicated under a tab and with today's date indicated so that we know when we modeled this particular trade. We are going to be also looking at these options in terms of the class of option that is being used. So we are going to be doing first an example on an in-the-money call, which as you can see is below the market price. We're going to do a near-the-money call, what is generally referred to or at-the-money call sale, and also we're going to be doing the sale of an out-of-the-money call to continue the illustrations to see the differences between different classes of options. Be sure to review your terminology so that you understand the difference between an in-the-money, at-the-money, and out-of-the-money option with the narrative as well as in our reference section. Now let's go ahead and look at some of our examples. If we're looking at the June contract today on the Dow Jones, the Dow Jones is trading around 16,194, and these prices were obtained earlier, so again they're not a real-time trade. They're for illustration purposes of how to input and monitor a trade. As you can see, once you input a trade, you select the Dow Jones Industrial Average contract. The contract specifications appear along with a dialog box that takes you to the contract specs that we saw earlier, as well as the news on the market. When you select sell a call, the dialog box comes out, which is a profit and loss graph that reminds you at a glance and reinforces the visual understanding that this trade anticipates a downward direction and downward volatility. It is also possible to click on that box so that we can go back to the particulars and the details of when to short, grant, or write a call. Input the number of contracts and the strike price, for which again there is a dialog box that appears with an additional help link to further details on strike prices and classes of options. We have an input of how to list the cost or the price of the option, again with a link to further explanations and discussions of how premium works. And of course, like any good business, we input the costs of the transaction, and then we come up with an outlay. When selling a call, we have the first summary boxes where we can see the trade. The first one is the very particulars of the position, the premium that was in this particular scenario collected, translated into what matters, dollars and cents, which is a feature of the calculator. So we know that this 42.8 in premium is actually $4,280. And of course, when we take that, we factor in the transaction costs, and there is a net credit on the trade in this particular scenario of $4,225, which again, based on the tick value of $10 a tick or 100 times the index, equals 42.25 in premium. So this is the number that we monitor for a break even. The person has to be able to purchase back the option for less than 42.25, which is what was collected. As you can see, and this is the case whenever you sell a call or you sell a put or any net credit trade, the maximum that can be earned on this position, the maximum that can be gained by the seller of this option is the net amount collected, which is the premium collected, the total premium collected, from which you deduct the transaction costs, and that gives you either a net premium break-even of 42.25, which is a total of 42.25 as a maximum profit potential, and also enables you to calculate the intrinsic or the futures break-even or the contract break-even point at 16,142.25. Once we look at this, and of course you monitor the premiums regularly, let's have a look and see intrinsically at expiration, and of course intrinsically before expiration, how this trade would look on a spreadsheet. As you can see, and we've indicated this before, this is a bearish trade looking for falling volatility. So if the trade is correct, no matter how bearish the market is, no matter how much it drops, as you can see, the maximum that can be earned on this position is 42.25, which is the initial credit collected, the initial net credit collected. On the other hand, if this person is mistaken and the market goes up, and it goes up with rising volatility, the loss scenario is then limited $10 per tick move above 16,142.25. So if this person is not just mistaken about the direction, but is mistaken about the volatility, and the market doesn't just go up, but it goes up with rising volatility, as you can see there's a tick for tick loss, and the losses can become pretty significant because you're going at $100 a point 100 times the index. So a person would have to have a fair level of confidence in this particular case that the market is not going to break out above its break-even level, and that in fact it's going to drop or it's going to flounder around these numbers. So this particular example, as we indicated, is an example of selling an in-the-money option, which is fairly costly. The next example, and remember you do need to review in, at, and out of the money options, is a scenario that is not quite as bearish as the previous one. The seller of this option, again, it has all the features, we're selling a call, but this time the sale is at 16,400. This option is about 200 plus Dow Jones points away from the market. So there is a bigger margin of error for a rally. There's still an anticipation of the market going down or having falling volatility, but the writer of this option is willing to collect less money. He's willing to collect less money in order to have a larger margin of error in case the market goes to the upside contrary to expectations. Again, we look at the particulars of the trade here. Now we see that 26 premium points have been collected, and that's at $100. That's 2,600. We get the net monetary value in green, which is a credit collected, minus the transaction costs, and we have a net credit on the trade of 25.45. And again, as we indicated, The net credit after costs is also the maximum profit potential on the trade. In this particular case, 25.45. The 25.45 is also translated into premium points so that you can monitor the values day to day. If you collected 25.45 for this option but can buy it back for less, you would be making money. If you have to buy it back for more, then you would be losing. And in either direction, that would be at $10 per tick. Because this is, again, a naked margin position, as we indicated in the trade details, and as you can see here in the box, if the market, contrary to expectation, goes up with rising volatility, then that position begins to lose money intrinsically above 16,425.45 on the instrument or 25.45 on the premium. Be sure to monitor both to get a balanced view of both intrinsic value and premium value. Now, as we indicated before, on the bearish scenario, because a person is collecting premium on falling volatility, the maximum gain, no matter how much the Dow Jones contract would fall, is the net premium collected. And on the other hand, on the upside, if the anticipation is mistaken, as you can see, the tick value goes up, and on a big breakout, it is a margin trade, and the deficits can be significant, especially on a large move in the opposite direction. And as you can see here, we're talking there on a $10 per tick move above that intrinsic value or above the tick value. When looking at the break-evens on this trade, as you can see in this particular scenario, the break-even is at 16,425.45, so that the particular seller of this option has 245 Dow Jones points, so to speak, worth of cushion based on a futures price around 16,192, 195. So as you can see, there are more than 200 points of premium there, 225 points of premium, 225 points of cushion before this option goes intrinsic. So if this market does nothing from now till expiration, in theory, that entire premium and the maximum gain would be achieved. Even if the market should find its way up, for argument's sake, to 16,000, and again, this is the number we have is 16,400, the maximum gain is still achieved, although the direction was wrong. So in this case, a person is bearish, they're mistaken, the market goes up to 16,400, and at expiration they can still keep that premium because it did not rise with sufficiently increasing volatility. So although the direction was up, contrary to expectation, the diminishing volatility worked sufficiently well to overcome the wrong direction, and still at these various numbers on the way up still helps the writer of the option to maintain a gain by being half right. Wrong on direction, but right on volatility, and there's a further cushion, as you can see, until the entire premium that was collected as a cushion is exhausted, and then the trade begins to go into losses, and those would be specifically at the premium and contract break-even points that are listed. And this would be an out-of-the-money option. I guess opinions vary whether this is just an out-of-the-money or far out-of-the-money option. That's something that has to be reviewed and discussed because it's strictly a matter of opinion on what the likelihood is of a market making a move in a certain direction. Finally, we're going to look at our last example, which is an even farther out of the money and option, and this particular one is betting simply that the market will not break above 17,000 by the June option expiration. So when we look at those particulars again, Same contract, same particulars in terms of the expectation for a down market with diminishing volatility. Somebody who writes this farther out of the money option wants to have greater margin of error and is willing to collect less money in order to incur losses only on a larger and more volatile move. So in this particular scenario, collecting 5.7 points is $570, significantly less than the in the money or near the money option or nearer to the money option. And the net collected in this scenario is 515. On the other hand, which the maximum that can be made, as we know already, is for the 515, the net credit collected after all expenses and premiums. But in addition to receiving a smaller premium, the futures break even now for this particular speculator intrinsically is at 17,005.15. So if this person is bearish, the reason they're writing an option and taking this margin risk, a tick-by-tick move above 17,005.15 or above 515 in premium, is simple. Because they have room between now and expiration all the way to 17,000 and 17,000 to be fully keeping the premium that they collected. So although it's less money collected, there is what some people, certainly somebody who would contemplate this trade, would consider a sufficient margin of error to take the risk. Let's have a look again at where the break-even are. Would be at 515. So if the market, if they can buy back this option for less money, then they are gaining. If they have to buy it back for more money, then they are losing, and the tick value is $10 per tick. And the futures break-even is 17,005.15. Let's have a look at it on the spreadsheet. And again, this particular person is not hugely aggressively bearish. They're looking for diminishing volatility. So on a drop, no matter how significant the drop, the maximum that can be made is the premium collected. And if you see this go down to 15,000 or 14,000, this 515 is the maximum gain that can be achieved. On the upside, however, although there's a decent margin of error and the maximum gain at expiration can even be achieved on a wrong directional outlook, as long as the market stays at 17,000 or below on expiration, the maximum gain can be achieved even after the market on this calculation would make an up move of over 800 points. So let's say if we round up and say that the Dow is around 16,200 for argument's sake, this bearish speculation could be wrong. The market could proceed to an 800-point rally from these levels, and yet because the volatility would be insufficient to overcome how far the option is out of the money and how much the premium was that was collected, even at 17,000 on expiration, the person could keep the maximum. And then, of course, intrinsically, there are still some smaller diminishing gains to be made as the market begins to move up. And then, of course, once it breaks out above the instrument break-even or the premium break-even, as you can see here, the losses begin, and they're at $10 a tick. This person would have to be extraordinarily wrong, both on direction and on volatility outlook, to begin to incur these losses. And that's something to keep in mind, however, when somebody puts on this trade. No matter what the confidence level, it is a margin trade, and they should make sure that they are in a position to take that risk, even if they're comfortable with a margin of error on the trade. Conversely, as we discussed previously, the counterparty to this trade, the person buying this option, is fighting time decay, just the way this particular writer is benefiting from time decay, and that person needs a significant, relatively explosive rising volatility upside move to overcome the premium that they paid. So we can see how both counterparties operate under this scenario in their speculation. I see that we had a question come in here. Just a moment. on how to diminish the risk on these positions if somebody wants to minimize their risk on writing calls. So let's go back briefly to the strategy gallery. Let me review the question I have in the dialog box here. The question was as follows. If I want to collect premium but don't want to take the unlimited margin risk, how can I go about it? Okay, that's actually a very good question. It's a very commonplace concern. And I think that when we go to our strategy gallery again, the person who would be doing that would still be bearish, obviously, but they would be very concerned about the risk of writing a naked call. So in a scenario like that, a person would go ahead, look at these particular positions, and initiate a synthetic. There are multiple strategies you can use. You can be bearish by selling a call and then buying a call to cover on top. So when you look at the synthetics on the bear put spreads, which are in our synthetic gallery, you can see a number of those strategies that you can input. So let me go back to our example, if I may. And we can make an adjustment in which somebody who is worried about their upside risk is going to combine these two positions. We're going to another calculator. We're going to show selling a 16,400 call and buying the 17,000 call. And again, this is just a way to try to cap the risk or to mitigate the risk in case the market runs explosively to the upside and this person is not in a position to take a maximum risk. Then we would go ahead and go to one of our other calculators. Let's say we're going to go to our master combination calculator, and we're going to do a very quick input on the fly of the particular trade so that you can see how these particular inputs can be done. Again, we are looking at the Dow Jones contract, so we can start inputting the letters, and sure enough, there it is, and the contract specs appear. The trading strategy that we're going to have is we are going to be doing a call spread. Okay, and let's go ahead and input the default price. Let's say in this particular case, we're going to be buying the 17,000 call. We're going to be selling the 16,400. Okay, excuse me, we're going to be doing buying one and selling one. And we're just using the same values from before. I believe that we, on the 17,000, we paid 5.7 in premium.
Yeah, that's correct.
And I believe that on the 16.4, we did 26.
That's correct.
If that number is correct. So now, as you can see, although we're selling an option closer to the money, some of the money is going to be paid back. Some of the premium is repaid in order to cap the risk at 17,000. And let's see how that looks. It may or may not make sense. That's a great thing about a calculator. We don't have to guess. At least we can have some numbers. Now, as you can see, the particulars change on this trade. This is a credit spread. There was a purchase for 570. 2,600 was collected for a net credit. For a net credit of 2,030, and again after the transaction cost, it's 1960. That's the most that can be made on the trade. And then, as you can see, with a maximum of 1960 that can be made on the trade, the loss is limited to the spread minus the differential. So you would take 1960 and you subtract that from the difference here, which is 600 points. That's one. So that would look at 1960. So you would still be incurring a pretty significant risk, although it would be capped at 17,000. So in this particular scenario, I think that somebody who's not in a position to incur this kind of a loss, which is a loss of 600 points, which is very significant, would be better off reconsidering because even on a capped risk like this, the risk can be pretty significant, as serious as any margin position. I believe that would be it. We'll be doing some programs on covered spreads, which includes call credit spreads, put credit spreads, and in combination. There are iron condors that can be used as well, so that premium can be collected on both sides and reinsured with covering options. I think that's going to cover our writing call program for today. We will be, if you have any questions specifically on premium, classes of options, in, out of the money options, or how to forecast volatility, be sure to stay in contact with us and tune in for future programming. I think that's going to be it for the day. Everybody have a super day and good luck in your trades. Keep working at it.
Thank you, Mr. Mueller. Everybody have a great day. Thank you.